Folks, they are still so dang bearish. It is incredible. I thought I'd go ahead and react to this one here today, folks. One video only for me to react to. I want to react to the first 8 minutes roughly here of Fast Money, okay? The latest Fast Money show. Now, it's interesting because they actually didn't even have the most bearish guy on, whose name's Dan Nathan, okay? And Fast Money is a show that I watch religiously. I would say almost every single episode for the past year or so I've watched, okay? And it's one of only probably 2 stock market related things that I watch religiously. One's Fast Money. The reason I kind of watch Fast Money, 2 core reasons. One is it's on shortly after earnings come out, so I love to just kind of hear little inputs like numbers that are hitting across the line, even companies that I wouldn't even usually pay attention to, right? So I like it from that perspective. Second reason I watch that show often is at the end of the day, it's all Wall Streeters. These people run money, and I love to just hear their sentiment, their vibes, okay? Now, on a day like today, right, where, and I'm going to be releasing this video tomorrow, but great news came out, right? Jobs report much better than expected. The Dow had a huge move up. The Russell outperformed everything. The thing that all the Wall Streeters said, you know what, we don't believe in this market until we see all these other indexes and stocks run. You can't just be NVIDIA and Meta and Tesla and a few of these big dog stocks and Apple and Microsoft. It needs to be the whole market. Well, that happened today. And so I love to hear sentiment, okay? The other thing I like to watch religiously is actually a YouTuber named Maverick of Wall Street, who's I've watched him religiously for the past year, almost every single episode he comes out with. Very bearish. I love to hear people with bearish perspectives. I really do. And although at the end of the day, I'm obviously optimistic, right? I'm going to always lean bullish, right? And so naturally, I get more enjoyment from watching bears in bearish perspectives because it just gives me some cautious outlook. Because if there's anything that I know personally about me, I can sometimes feel too optimistic, too bullish. And so I love kind of hearing bearish perspectives because it brings me down just a little bit, and it's just kind of brings me out to like a healthy balance in my opinion. So yeah, looking forward to getting in this one with you guys. Thanks for being subscribed, folks. I think we're now over 28,000 subscribers now on the channel, new all-time high. So I appreciate each and every one of you. And yeah, let's go ahead and get into this. What I want you guys to pay attention to, and I'll stop the video in a few moments, is how either bearish a lot of the commentary is, or how, let's call it that middle ground of kind of like, not very bullish, not very optimistic, okay? Just kind of in that middle ground.
Nyson, Steve Grasso, Guy Adami, and Julie Beal. We start off with a jobs-led rally on Wall Street. The Dow jumping more than 2%, its best day since January. The S&P posting its highest close since August. The Nasdaq, its best level in over a year. The tech-heavy index now up for 6 straight weeks. That's its longest winning streak since early 2020. And take a look at some of the leaders today. Cyclicals like energy, materials, and industrials, along with small caps outperforming the broader market. Meantime, recent standouts like tech and communication services were lagging, both up less than 1%. So what does this divergence say about today's market rally? Are we in for mean reversion, Grasso?
Yeah, I think you could see a little bit of that. That always happens with the marketplace. I think the steel angle of this is you have, as you stated, you have the debt deal that's done, you have the Fed who's close to being done, and then you have China stimulus. All of that is a recipe to watch these stock sectors sort of take the lead right now. But I think you need that reversion back off of the hoopla from the tech names.
Yeah, I think it's a mix of better economic data than expected and under allocation in the areas that have outperformed today. Right? We've talked ad nauseum essentially how tech has really led this move higher. There's been no shortage of coverage in terms of how we've been underinvested in terms of exposure to equities in particular.
When he says there's been no shortage of coverage on how we've been underinvested in equities, and that's because, overwhelmingly, it seems like a lot of these fast money guys lean bearish and have leaned bearish, and I've been talking about shorts and being cash heavy and these sorts of things. And as somebody that watches almost every single episode, that's the way a lot of them lean. And like I said, they don't even have 2 of the guys that are on today that are usually very, very bearish, including the most bearish of all of them, in my opinion, this Dan Nathan guy, who just seems like he says nothing but negative stuff about the market and stocks all the time.
Exposure to cyclicals throughout this cycle. And I think today was just kind of a culmination of all of that coming together. You had that jobs report that essentially on when I first saw it, I was like, oh my goodness, let's look out for today. And then when you kind of parse the data, the wage inflation pressures that we really thought were going to be eroding factors and really cause the Fed to continue to be more aggressive seem to abate. So I think, like you said, a Goldilocks situation, that coupled with the fact that we've been probably underinvested in these areas, led to the squeeze higher we saw today.
Yeah, Julie Beal, I was thinking of you as I saw mid caps and small caps outperform today. Do you think this lasts?
I think it's the same concept of mean reversion that we've been seeing, where they have just been absolutely annihilated the last the last year or so. So I think you would expect, if cyclicals are coming back in favor, people are going to be feeling more favorably towards small and mid caps. But I still think you need to be very, very choosy. These businesses are often have more leverage. They often are more cyclically sensitive, and the consumer isn't in great shape, as we'll talk about later with Dollar General.
So it's a very cautious commentary there. Okay, that's something very important to pay attention to. She's very cautious. You got to be really choosy. It's not like she's feeling overwhelming bullish. If she was just feeling really bullish, she'd just be saying, these indexes are about to move and going to keep moving, right? She's like, you got to be, it's stock pickers market. We talk about that a lot recently, right? It's a stock pickers market.
Yeah, Guy, do you think that this baby AI bubble that we've witnessed, I don't know if you call it baby because it's pretty darn big.
She just called AI a big bubble. And this is one of the funny things that I've noticed about Fast Money and in a lot of CNBC is they've leaned toward basically calling this whole AI thing a bubble, which is fascinating. Because I'll be honest, Kate, I've seen CNBC since I started in the stock market 2008, 2009, and they don't usually seem to take a very strong stance on things. And so I do think it's been funny listening to these folks talk about bubble. They, the way they talk about it, it's just crazy hype and bubble and use all these, adjectives and words that just, and you know what it makes me think? I think to myself, maybe just maybe it's not a big bubble. Maybe this is the start of a major trend that's going to be a several-year trend. Who knows, okay? That's just my little hunch in regards to that, right? Because I've never seen such a strong stance from a lot of these folks. Oh, it's not a small bubble. Listen to the way her commentary here.
And have more leverage. They often are more cyclically sensitive. And, the consumer isn't in great shape, as we'll talk about later with Dollar General.
Yeah, Guy, do you think...
Oh, I missed that. We'll talk about that later with Dollar General. Everybody getting caught up in Dollar General. Like Dollar General... The Dollar General doing bad means the economy's in a bad place. What? What are we talking about here? Okay, the dollar stores do great. The best thing is the economy's wrecked. Dollar stores do great. Look at how dollar stores did in 2008, 2009, 2010, 2011, in very weak economic years. Dollar stores did phenomenal in that time. Usually if dollar stores are doing bad, that usually means the economy is probably in too good of a place at that particular time. So that is something to keep in mind. I would not look at dollar store and be like, wow, the dollar store's numbers are so bad, the stock's doing so bad, and be like, oh, that means the economy is devastated. If anything, that means completely the opposite. So that's just been comical that I've seen that commentary out there. I'm just like, what are we talking about here, man?
This baby AI bubble that we've witnessed, I don't know if you call it baby because it's pretty darn big, and it led to a record amount of inflows in the latest week into the tech sector, according to Bank of America. Is that done? Have we seen the peak of that?
Listen, I would hope it's done, cool off for a while. I think it gives people time to sort of ascertain what's going on and maybe make more reasonable decisions. But, Goldilocks is one of those...
It says people aren't making reasonable decisions. That's an interesting take. That's a very bearish take, right?
It makes me sort of wince, and I'm sure you can see it out of the corner of your eye, me making that face. But there's really nothing Goldilocks out there other than the broader market continues to go up every day. Unemployment's starting to tick up. Maybe that is a good thing, but just the way the Fed thought they could control inflation, which they couldn't, they somehow think they're going to be able to control the unemployment rate going higher, which they won't be able to. And, under the surface, there are a lot of things to be concerned about. We can talk about the health of the consumer. I'll tell you, we're going to look at a WEHK chart later. One of those retailers is telling a much different story. So I get it. Market's going higher. I understand why people are euphoric. It just gets more expensive every day. There's nothing going on to suggest that it's anything but multiple expansion and a chase.
It is.
So his take on the market is nothing but a multiple expansion and chase. There's nothing real here with NVIDIA. With any of these stocks that are doing well, there's no maybe they're actually got earnings are going to go up quite a bit over this next year, right? And that's certainly that's an extremely bearish perspective. by saying that you just believe this market is just going up because, it's just valuations are pushing up, there's nothing to it, basically. It's a very bearish perspective. A very bearish perspective. And let me tell you something about this gentleman right here, okay? Let me tell you something about him. There's a gentleman that said last week that he was going into NVIDIA earnings with put positions, okay? That's what he said on Fast Money. And yeah, it was either put positions, he said, or short. It was one of the two. He was either short the shares or he's buying puts, right? We know how that ended up, obviously, right? We know how that ended up. So, you got to think about these things a little bit.
Head scratching. I mean, you hear about all of these headwinds to the consumer. You got SNAP benefits ending, the end of the child tax credit. You have the student loan moratorium ending, which will lead to an average of $393 per month per borrower, according to JP Morgan. That seems like a lot of money per month to be now shelling out for student loans as opposed to travel or a sweater or you name it, Grasso.
That's a good point. She brought up a good point, and I think that's a fair bearish point to bring up right now, is the whole student loan situation. People have to start paying back student loans that are in that situation. That's obviously not everybody, right? Maybe it's some of you guys watching this. Maybe it's not some of you guys. But there's certainly some folks that are going to have to start paying those loans back, right? And it's less money that they can spend other places. So that's something that's definitely, let's call it a negative for the overall economic landscape.
Yeah, sort of back to reality, right? So these are all things that we all had to pay for once upon a time. And I think it gets back to what Guy touched on with the unemployment number. As long as you have a job, as long as you have some income coming in, then you're going to spend money. The problem is, to Guy's point, when the music stops. Do we think the music is going to stop? It doesn't appear that the music is going to stop. You figure there's a disconnect between that unemployment rate and the real big macro numbers, and how many people are gig workers versus full-time workers. So I think there's a lot of noise in this, and people, yes, euphoric. Mm-hmm. That's the main word I would go with, and I think
euphoric. How are people euphoric? Who's euphoric? Who is he talking about is euphoric on the market? And it's like, it's just going to go up. Other than Tom Lee, I don't know anybody that's really euphoric on the market. Okay, Tom Lee says the S&P, he was on the other day, and I think I actually reacted to that on the channel, right? And if you want to watch that, it's on the channel. A few days ago, I posted that. Tom Lee says that he believes S&P 500 was going to go up another 10% this year or so. Yeah, at least 10%, I believe he said, right? 10% plus. So that's somebody that you could put him into the euphoric camp. But gosh, I watch a lot of CNBC. Fast Money is just one show, and I'll have it on in the background all the time. I'm doing work on my computer, up at the counter there, doing work on the couch, like all over the place, right? Sometimes I'll even have the doors all open, and I'll be outside doing work on that table, and I hear it on. I listen to these Wall Streeters go on. I don't hear anybody very euphoric ever, okay? You know what they either are? They're either kind of in the neutral camp, right? Not really super bearish, not really, they're just kind of like cautious. Let's call it that. They're the cautious camp. Okay, not super bearish, not super bullish, and bearish people. That's all that goes on CNBC, and these are all the Wall Streeters that control the money all the time, man. Even a lot of the big money has been either in one of those two camps, bearish or cautious. So this whole everybody's euphoric, it's just not the reality. And you could say, what about in the retail trade? No, retail's not even in this market right now. Like the amount of retail folks in this market is a very small amount. Good for you guys. You've been making a lot of money this past 9 months. Good for you guys. And you'll make a whole lot more money in the future. But, I mean, I can tell you, most retail's not here. So who's he talking about? It's so euphoric. Because that's just not the reality. At all.
when you really look at what they're spending money on, you can't get on a flight. You can't.
I'll pull you up the latest. Let me go inside the Discord chat. I'll pull you up the latest numbers. Alrighty, folks, now we're in the private group's Discord chat. Let me show you something here. Weekly investor report. Let me take you in here for just a moment for our latest investor report here, okay? Let's go down here. AII investor sentiment, right? Just one of a million things we cover, in this report each week, right? For everybody that's in the private group. Look at this. 29% of market participants are bullish on the market the next 6 months. 34% is neutral. Almost 37% is bearish, right? Yeah, the number's up a bit, but at the end of the day, the market's still, even after all this move, even after everything that's happened, is still overwhelmingly bearish and neutral. I mean, That's telling you a lot, man. The historical average is 37.5% bullish, okay? We've only been there once, and that was a February 8th, 2023. We've only been to the historical average once in the past year, man. That's insane, right? And think about how bearish the market was back in September, October. I mean, 60% plus people bearish. That's just astronomically high. Everybody was convinced the market was going lower. And it went, then shortly after that, straight up, man. Straight dang up. Incredible. Absolutely incredible. By the way, if you're looking to join my private group, it'll be pinned comment down there if you're looking to apply to join us in there.
Can't get into a hotel. We're going into peak travel season. We're going into peak vacation season. People are still out there spending money. And when it comes down like a hammer, if it ever does, I don't know. It just seems that people still, we're talking about historic low unemployment. Even if it ticks up a percentage point, we're at historic low levels. It's been the most hated rally, and that means it'll still continue.
Right, and you can make every single...
This guy's like, oh, F my life, man. He's like, damn it. No, I'm too short. This market.
And every argument, to use a guy word, could be a cogent argument as to why the market should not be valued where it is valued right now, which is what, 18 times forward or something like that. But you have a market here that is moving on momentum. And so Bonawyn, trying to fight this has been a losing battle, painful battle for many out there. When do you decide, you know what, I'm just going to go with this momentum? You have to trade the market that you have.
You have to. I mean, I've experienced some pain. I'm not going to back away from my thesis on the market. I think that
he's experienced some pain, and that's just a lot. That's what I was telling you guys about, right? There's the most hated bull market. I don't even really want to call it a bull market. This is just the most hated stock market I've seen in my 15 years of being in the market. I've never seen a market this hated. Why is it so damn hated? The Wall Streeters, way too heavy cash going into this year, way too heavy put options, way too heavy shorts going into 2023, okay? Retail completely left the market in 2022. Other than a few people, some of you guys that are happy to be here for the next 10, 20, 30 years, right? So retail that left, if they're even keeping track of anything, which most of them aren't, okay, they're frustrated as hell, and especially because a lot of those folks then went from losing their butts on long positions to then swapping out mid-year and late in the year in 2022 to short positions and puts, and then just got doubly whammed, okay? That's what you call a cheesecake factory, okay? It's nasty style. That's what happened to them, and all these Wall Streeters are like, what the hell, man? Like, my puts are expiring worthless all over the place. I'm having to cover shorts with massive losses. And I got money chilling in treasuries and stuff while I collect my 5% a year, and I'm watching NVIDIA stock go up 150%. What am I doing here, okay? And their clients might even be putting pressure on them, saying, what are you doing, man? If I wanted to buy treasuries, I'd buy treasuries myself. What are you managing my money for?
Kind of crazy. Steve, you mentioned the spending. I'll kind of paint the picture a slightly different way. So yes, maybe the consumer is still compelled to spend. But we're already talking about credit pullbacks within the commercial space. I'll tell you what banks don't want. They don't want their loan portfolio being more skewed to consumer debt than they want it to be skewed to commercial debt. They don't want those ratios getting out of line. Those are the type of cracks that I look at, which makes me say, to Guy's point, it's nothing but multiple expansion. Yes, it's also why we all sit here and say you have to be invested to a certain extent. It's about whether you're...
It's not all multiple expansion, okay? Some of the biggest companies in the world are going to see their net income skyrocket over the next several quarters. Amazon, Meta, what's the other stock I'm thinking of? NVIDIA. Those are three of the biggest companies in the world. Their net income is going to skyrocket, not go up a little bit, skyrocket over the next several quarters. It's going to be shocking to see the type of growth on a year-over-year basis. And then you got Microsoft, who just continues to put up good numbers and continues to grow that bottom line in a very nice way. They're going to continue to put up their numbers, right? Apple, I've been waiting for their numbers to become a disaster for a year now, and somehow Apple still gets it done, okay? We'll just call it that, gets it done, where it's not a disaster. And it's like, how do they do this? They pull rabbits out of the hat. So for the biggest companies in the world, it's a tough play against those guys, man. This playing against the Michael Jordans of the stock market.
Hedge, I think at this point, though, given where the VIX is, where option prices are, and given the momentum to the upside that we've had, I think it makes a lot of sense to go on ahead and put on protection here. And if you want to continue to ride your longs, you can. I wouldn't do nothing.
I agree with him. Great point by this gentleman. If you do not have any hedges on the market, I think this next 30 to 90 days is a great time to add a little hedges to your portfolio if you don't have any. Maybe some hedge puts, maybe some that are dated out 6 months, some that are dated out 12 months. You could buy something like some calls on the VIX over the next month or two if you want. If, that are dated out 6 months, 12 months from now in the future. You can buy some inverse ETFs if you want, some SDAO or some SQQQ, something like that, something to hedge your portfolio. You could buy calls on some of those inverse ETFs. You could there's a lot of different ways you can hedge, right? And I did a really in-depth video on the private group a few weeks ago that went super in-depth on a ton of different hedging strategies that you can implement and exactly how those work. I agree with him. It's definitely, I think over the next few months is going to be a good opportunity that if you aren't hedged at all and you want to hedge your portfolio just in case the rainy day does come, hey, then you're hedged.
And I certainly wouldn't be piling more money into the market, but I would be doing it in a way that, fine, you want the upside participation, maybe do it through calls, or if you want the cash outlay through cash equities, you can still put on some.
I obviously disagree with him completely in terms of that. Like, if you see great stocks at great prices that you love for the next 3, 5, 7 years, buy those freaking stocks, okay? Buy them. Don't worry about call options. Then you're putting yourself under a time crunch that's very stressful, obviously. If you see PayPal and you say, I love PayPal, buy the flipping flapjack in stock, throw it in the filing cabinet, forget about it. If you see, Tesla and you love Tesla and you believe it's going to be this valuation because you believe its net income's going to this over the coming years for XYZ reason, boom, make it happen, man. Don't wait on this whole perfectly timed the market because that's what these guys were doing. They had an opportunity to buy S&P at 3,700 last year, but a lot of them that wasn't good enough. They wanted 3,400, 3,200. Oh, it's going to 3,000. Well, remember the guy, what's his name, Mike Wilson or whatever? Mr. Was it Morgan Stanley guy? Where's he at? I just thought about him. Where is he at? I got to find him.
Pretty cheaply. And
Chicken.
At the upside, you're only spending a fraction of that on protection anyways.
This sounds like a Guy's favorite show, Options Action, which starts in about 23 minutes.
No, it just started.
But Bono makes a good point. I mean, the VIX at 14 and change is just, it's unbelievable here. Guy.
In all due respect, what's so unbelievable about it? Why should the VIX be 30 right now? Okay, what's so unbelievable about it at 14? Keep in mind the VIX in a normal environment is 10 to 15. In a normal environment. The VIX is only 20 plus when you're in kind of extraordinary time periods of volatility. Why should we be in a time period right now? Everything that's kind of going on, it's no drama. We got inflation coming in month after month after month exactly where we need it, right? Unemployment stays really low. Earnings have held up pretty respectably decent and look like they're going to get better as this year goes along for many companies. I mean, you don't have a lot to go off of. There hasn't been any crazy things to happen in the world since obviously, Russia, right? Obviously going in there. That was back in, when did they go in there? February 2022? I mean, it was 16 months ago or so now at this point in time. It was quite a while ago. And so we haven't had anything epically crazy happen since then. And so what do you have to go off of from kind of to push the VIX up right now?
I mean, Mel, I'm sorry. I apologize. No, it is.
Only because we were discussing this on our phone call earlier today. The VIX being at 14.
And what I'll say, and I apologize, and I'll say this, I think, we'll probably do something on this over the next couple of weeks, but these zero to expiry options or whatever they're calling them, I think that's been a big part that I really haven't figured out yet, but a lot more people are talking about the rise in them.
You've been watching MAV, man. You've been watching MAV or what's going on here?
Amount of volume that's traded there is sort of tamping down the volatility index. And that's one of those things, and I'll never use this term, but people will start talking about the VIX being somewhat of a coiled spring. So I don't think you're getting paid enough at these levels to sell upside calls, but you're certainly looking at volatility where if you want to buy put protection, it probably does make sense to Bonowin's point.
0-day options for the S&P 500, by the way, more than 40% of the total options volume for the S&P. So this is not an insignificant force in the market, certainly at this point. Let's move on here. Steel producers helping the materials sector shine bright.
That was it. So obviously that's much of Wall Street's tone still. Very cautious or bearish. you find a lot, and I mean a lot more cautious and bearish people in this market still. Even after this move, even after time's ticked on here, that's still the way it is. And you know what it makes me? It makes me feel more comfortable than ever in the market. With my hedges I have on in the market, with my long positions, I couldn't feel more comfortable, and especially given the sentiment. If everybody was bullish right now and all these guys were, euphoric today, I would be much more cautious. I would actually probably be buying some of my hedges a little heavier in that given scenario. But it's just not what we have on Wall Street right now. Very cautious, very bearish. I appreciate everybody joining me as always. Thanks so much for being here, folks. If you're looking to apply to join my private group this upcoming week, I invite you to apply. That will be the pinned comment down there to fill out an application to join us in there. Much love and have a great day.